So, how do banks actually price mortgages? How have deposit rates and savings rates in the last year affected price changes? Are these high arrangement fees from banks here to stay? And where do we see mortgage rates going at the end of 2025? And what are the factors that are going to affect that? I speak with Daryl Norkett, Head of Real Estate Proposition for Shawbrook Bank, to find out all of these and more. So have a listen or have a watch, and please don't forget to subscribe. Hello, everyone, and welcome to another episode of the Rodcast. Today, I'm really happy to welcome back Daryl Norkett, Director of Real Estate Proposition from Shawbrook Bank, who's been on the Rodcast a few times now. Daryl, welcome back. How are you?
Yeah, very well. Thanks for having me, Rod. I'm delighted to be back on the podcast.
It's always good to have you. We always get some really insightful comments from you about banking and the way that the mortgage market works. And I'm hoping today is going to be no different. So I'm going to get straight in because over the last couple of years, or certainly since the Liz Truss budget, everyone's been talking about, oh, rates are cutting. That's why rates are cutting. And now there seems to be a bit of a realization now that, do you know what? Even if base rates are cutting, our mortgage rates may not be rocketing or shooting down at a rapid rate. And where we've got these inflationary pressures like the latest budget from Rachel Reeves, this war in Ukraine, Donald Trump's global kind of tariffs, although the UK is probably not going to see much of that. Um, so there's a lot of inflationary pressures about mortgage prices. How are banks like Shawbrook actually pricing loans at the moment?
Well, there's, like you say, Rod, there's so many things going on that it's impossible to forecast what's going to happen next. So we spend a lot of time thinking about it, but there's so many variables that can affect the markets. And what I would say is the swap rate is still a good guide for how we think about the long-term cost of money. Um, and it's a little bit less volatile than it was before. So for most of this year, the 5-year swap rate has hovered around 4%. We've had a few times it's dipped below. We've had a little wobble in early February where it went up to about 4.2-ish. But by historical standards, since the credit crunch, that's actually, 20, 25 bit movements are actually pretty volatile. We didn't really see that before. But in the context of what's happened since the trust mini budget, that's actually quite stable. So cost of funds hasn't been moving around all that much for
And
quite some time.
just on that point about volatility, I'm guessing, correct me if I'm wrong, that volatility is not good for the mortgage market because it makes pricing it even more difficult. And so inevitably what happens there is things like loan to values start to come down from banks and lenders because they're worried about what might come through next. Is that right? Is that why we want a more stable market, or are there other reasons?
Um, I don't think risk appetite around LTV gets impacted by cost of funds that much. It might do by affordability though, as obviously if rates go up, you can afford to borrow less, and that might drag your loans value down. I think the main reason we want stability is that you know where you stand and you can plan around it. Because the thing with property is that transactions are painfully slow, unfortunately. We'd love for that to be different. And as a bank, we try and come up with all sorts of ways we can make the finance part of that better. But fundamentally, UK property transactions are pretty slow. So you need to do a deal months before you actually borrow the money. And therefore you need to know what it's going to cost you to borrow the money. So that's why stability is helpful, I think, for anyone in the mortgage market. But I mean, for us, it's the same thing, right? We offer you a loan before you're going to complete it. So we carry some interest rate risk on that, which is managed by what's called hedging. But there's still risk around the edges because you never hedge 100% of everything you've offered, because 100% of everything you've offered doesn't complete either. So it's all kind of to do with how the pipeline usually performs over time. So stability just means that pricing changes less. And if pricing changes less, it's easier for you to plan and ultimately validate a deal still looks a good deal after finance cost.
Great. And you mentioned obviously the swap rates is a good benchmark for everyone to look at. What other factors come into play then when pricing from a bank's point of view? Because I know kind of from 2009 up to 2020 probably, people kind of forgot about deposits because there wasn't really much interest there. But now we're seeing that deposits are making a margin for banks. And so how's that affected things?
Yes, that actually bringing up deposits is really relevant because swap rates don't actually have much to do with what the actual cost of funds is for a bank, but we use it as a bit of a guide for what the market thinks the deposit rates will do. And the deposit rates are everything for our cost of funds as a retail bank because we take in savings and we lend them out. Very traditional. So that's probably the single big, well, that is by far the single biggest component of costs and funds. There's obviously other things around the edge though. Banks have got an operation, those costs have got to be paid for. It's underwriters or sales staff or people to make sure your payments are collected on time, deal with a problem, all this sort of stuff has got to be paid for. And then banks need to earn a margin on top of that.
And
So
so,
I mean the profit and loss for loan, to be honest, doesn't look that different to a profit and loss for anything else you're doing business.
no, of course. I mean, that's your stock really is the pound note, isn't
Yeah.
it? So you've got to you're trading that stock and you've got to make a margin on it. And you talked about your other costs, so your operational costs, like your underwriting and I don't know, just people working at the bank and what have you. And I'm guessing that's why when you have smaller loans, um, you're going to see a bit of a higher margin on those to take into consideration those operational costs as a percentage, I guess, of that whole loan. Whereas bigger loans, you can probably lose a little bit there, can't you?
Yeah, and it depends to what degree you can automate. So some smaller loans are really straightforward and you can try and automate through the use of, say, AVM technology for valuations, fairly kind of scorecard-led decisioning for underwriting decisions, and you can make that process kind of really efficient, and that is a benefit to product pricing. But you get other smaller loans that are just as complicated and manual as a 5 million loan, to be honest with you, just because of what it is and the nature of it. And those are probably the most expensive loans for a bank to process, sort of pound for pound. So it very much depends on the nature of the deal. But one thing I would say is a bank's operational cost is still a very small component of the costs of offering that loan. In current market, by far and away, the cost of the money is the biggest cost.
Mhm. And so going on to that cost of money then, through savings deals, how has the last year's or 18 months savings deals that banks have been kind of putting out there? I mean, we all saw them kind of 4 or 5% fixed for a year and all those kind of things. And we're starting to see them come down now. And if you've got a bank account, you've probably had the odd couple of emails from, I don't know, whoever the bank is, say, "Hey, we're cutting interest rates on savings deals." But they're still pretty good. I mean, how have the last year's savings deals for banks affected the price changes in mortgages that you're giving out? Or your
Yeah, well, there is a direct one-to-one correlation, to be honest, the price of a savings account and the price of a mortgage, and it's not changed much over the last year. So I'd say deposit rates are edging down very slowly, but it takes quite a long time for that to kind of wash through the system. And certainly for us, mortgage pricing has been pretty stable for the last year. We try and sort of ride it out a little bit. So, you get some periods of time when the deposit rates move against you, some periods of time when they move back for you again. And we try and kind of stay patient with that. Some lenders don't take that approach. So generally speaking, the kind of more commoditized volume main players, their margins are so fine. They will move every time a deposit rate moves by a few bips. But in the specialist space, we don't tend to do that. But I think it's fair to say a year ago we kind of all hoped that rates might come down a bit faster. That hasn't really happened, and we're a bit lower than we were a year ago, but not materially.
and if rates had come down faster, would that have actually have caused some problems? Because if you'd put out all these saving rates at say 5% that were fixed for a year, would that have meant actually you wouldn't have been able to drop those rates for mortgages down as quickly because you've got to keep servicing those savings rates until they kind of drop off? Is that the case?
Potentially, so there is a risk with that, but not really for us. So I mean, most of what we do is still 5-year fixes. Like over half of what we do is 5-year fixes. So actually, the sort of 1-year cost of money over a 5-year period is not that material for the mortgage interest rate, unless it's obviously an enormous drop, which I think is unlikely.
Yeah.
And with the way that mortgage is funded by most banks, it's sort of forward funded up front anyway, with any kind of hedges against swaps and whatnot done at that point. So really, when you're raising deposits for your new loans, as opposed to your back book loans that are already funded. So you should see the kind of downside or the upside feed through to mortgage pricing, fairly quickly.
So people worried about what the pricing is going to be for mortgages going forward would be well advised to keep an eye on savings rates as well, I guess then.
Absolutely. It's usually my conversation I have all the time with borrowers. It's literally go and Google, Shawbrook savings account or whatever bank you want to look at, and you can see what it costs us to get the money in, and it gives you an idea of then what we might need to do to lend it out.
And what sort of margin are you looking at on those savings rates? Obviously, like this is very ballpark figure, but if you're borrowing at say 5%, sorry, borrowing at 4% and lending out at 5%, that's a 25% margin on that cost. I mean, is it that kind of thing, or
It very much depends. It depends how much risk that we perceive we're taking. It depends how much the complexity of the product, what the lender's operational costs are. So I don't think there is a ballpark, to be honest. A commercial property deal, for example, will always have a bigger margin than a residential property deal because the capital that the banks need to hold to support that loan is much, much higher because of the way the regulation works. So it's kind of sort of very nuanced, but I don't think you're going to get anyone do much at less than 1% above whatever their deposit rates are.
that's
Unless they've got really hefty fees or something like that, which is earning them an income in a different way.
That's an interesting point you made about the commercial mortgages because lots of people often think, "Oh no, it's because there's a sense that they're more risky." But it's not about that. It's just about the capital controls, I guess, that the is it the FCA? I guess
Bank of England.
Bank of England put on you. Do you want to just explain that a little bit more?
Yeah, so this only applies to banks, so the non-banks don't have to deal with this part of the regulation. But so for every pound that you lend, you can raise some of that as deposits, and you need to pledge some of your own money as a bank to support that loan. And the riskier that the Bank of England thinks that type of lending is, the more of the bank's money they'll want to support it should it go wrong. So generally speaking, with the regulator, residential property is viewed as the least risk, commercial kind of goes up the risk curve, and then development would be the largest risk that they do. So because of that, if you need to put more capital into that loan as the bank in order to do the deal, if you're looking at it from a returns perspective, you need a higher interest rate on it to earn the same return from the money that you're investing into doing that loan for that particular customer. And to be honest, it's not like banks have unlimited sources of that money either, because it comes from external investment or retained profits.
Yeah, so it's the return on capital that you're looking at as well, isn't it?
Yeah. Yeah.
Okay, that's really interesting. If you do enjoy this episode, please like and leave a comment or a review wherever you are watching or listening to it. Please make sure you're following or subscribe to the Rodcast on YouTube or your favorite podcast platform so that you don't miss an episode. You've talked a little bit about products there when we spoke about kind of the margins, and different products will obviously have different risks depending on what they're for. I'm seeing a lot more focus, it seems, from lenders around structured finance products now. Now, I don't know whether that's because more people are coming off these very low fixed rate mortgage products that they had and are seeing that there's a massive jump in interest rates, or if there's some other reason. But are you finding that there is any particularly popular products that customers need, or is it structured finance seems to be meeting a need at the moment?
Yeah, I mean, it depends on the scenario. So with loans coming off of an existing fixed rate, usually it's a 5-year fix they're coming off. So in the very, very ultra low rate environment, 5-year fix almost become like a default. There's very little alternative stuff going on. What we find with a lot of the kind of product transfer type stuff, or even kind of refinances to raise a bit of capital, is it's more varied. There's lots more people taking a view and wanting to fix for 2 years or for 3 years because they think that rates might be lower at that point, and that'll be the optimal time to take a longer term fix. We also launched a 10-year fixed product a couple of years ago, and as you can probably expect, demand for that's been relatively limited. But I think as rates come down, we might see some more mature property investors in particular think, you know what, 10 years is about aligned with my kind of retirement horizons, and actually let's just lock this in, because our generation have now gone through a kind of a volatile increase of interest rates, and kind of know the work and worry that can cause, and some of those long-term fixes can take that away. So I think in terms of sort of rate choice, it's definitely more varied than it used to be, because everyone's got their own personal opinion on what might happen to rates in the future. And I think in terms of sort of the nature of the lending, generally speaking, particularly in the buy-to-let market, there is a trend towards professionalisation. And with things like the Renters' Rights Bill coming in, even the EPC legislation actually the other week, it all creates more work to running that property business. And we are definitely seeing, whether sort of probably more anecdotally than the data at this stage, but we're hearing lots about, the more experienced, committed landlords who see themselves as running a property business, buying from the tired landlords who perhaps saw themselves as kind of part-time property investors and no longer want to run it. It's not the investment it once was. It's now a business. They didn't sign up for a business. We're sort of seeing a transfer of property, if you like, from one profile of landlord to another. And that is creating a demand, I think, for bigger loan facilities, for things with more bespoke arrangements, for things with more kind of personal structuring based on what someone wants to achieve. So that's definitely been a theme for us for the last kind of 12, 18 months. And we even set up our own team of relationship managers to deal with those sorts of transactions about a year ago. So the market is evolving. It's definitely at the stage where it's evolving.
And I think that's a really sensible approach, because when you see it evolving, you want to be able to meet the needs of the customer, don't you? Because so often I speak to investors who are just getting so fed up because there's not a specific product for something that's actually quite common in the marketplace, and they're kind of pulling their hair out trying to deal with kind of lenders that almost don't really want to be lending on that product, but seem to kind of be the only option. And I just think there's a lot of kind of I think there's room for some really interesting products to come out from some of the banks now.
Absolutely, and it's going to be kind of innovation and lenders adjusting to kind of a new world that sort of helps move things forward for people. But I think the market really sort of divides into two camps. You've got, well, three camps maybe. You've kind of got the traditional high street banks. If you're lowly leveraged and you just kind of want the cheapest possible money and they're happy to lend, then great, that's usually the right solution. Then you've got the kind of specialist banks and non-lenders that have set up in the middle, that have got a bit more appetite to lend, will offer you a higher loan to value, are quite comfortable doing interest only, or these sorts of things, but are still running quite a kind of a commoditized criteria-based process. And then you've got, kind of a cluster of what I would call really commercial lenders, but they specialize in lending to property investors, which means a lot of the deals are obviously residential security, but really we're lending to SME landlords, SME businesses. We're not looking at it as a kind of a buy-to-let mortgage for someone who's got a great job in the city. And mindset wise, and then the way you structure your business to deal with those sorts of customers is worlds apart.
Yeah. No, I think that's absolutely right. So, in terms of these products, we've seen these high arrangement fees around for a while. Well, certainly since Liz Truss, which caused them to come in to enable people to borrow at the existing loan to values that they were used to. Are these high arrangement costs here to stay?
I think in the medium term, unless something dramatic changes, yes. So things have got better we've seen quite a lot of rental inflation in the past few years, albeit it does appear to be slowing, and maybe we're hitting that affordability cap in some regions that means it can't continue to rise at the pace it has. But, net rents have gone up. Interest rates have softened a little bit, and hopefully they'll soften a little bit more, and property values have been flat. So all of that means that rental yields are up. What offsets that a bit is other costs for landlords are also increasing. So, whether it's the renters' rights bill or it's the need to do energy efficiency improvements, whatever way you slice it, there are other costs coming in that are not finance related, which is sort of the next wave of challenges, I guess, for a lot of landlords who've got their heads over the fact that money costs more than it used to. But I think the sort of outlook for profitability is looking better. But I still think certainly in London and the Southeast, those lower yielding regions, there'll be demand for higher fee, lower rate products in order to effectively trade some income for some cash flow. That's basically what it is.
I mean, well, it's almost like equity release, isn't it? Because you're getting
Yeah.
these products added to the loan, which means you've got to pay back more, in return for getting a bit of cash flow.
Yeah, but I also think the opposite is true too. I think there'll be demand for lower arrangement fee products, even if the rate has to be a bit higher in those regions where that sort of landlord profitability is starting to improve more quickly. So if I think about the Midlands at the moment, maybe parts of Yorkshire and places like that, I think it's going to depend on who you are, where you're investing in the country, and what your motivations are. But for me, in my head at the moment, I certainly think we need to offer more choice, because I think there's a more diverse range of needs and wants out there.
Yeah, definitely. I mean, you get a lot of kind of investors looking, sort of worrying more about cash flow if they've been in it for a while, especially at low rates, and they've become used to kind of certain expenses. And then you've got other ones that are more looking at it as really capital growth plays. And so very different wants and needs, I think. So I think that's sensible. Where do you then see mortgage rates by the end of this year?
If I knew that, Rod, I'd be on my yacht off somewhere nice. um, if things go as the market expects, which the only thing I know for sure is it probably won't, but if things do, then we should see mortgage rates kind of maybe soften it a bit. I'm talking maybe kind of 25 bits, maybe a bit more than that over the year, because the markets expect kind of another 1 to 2 base rate cuts, which sort of takes the high cost of funds off the first bit out of the equation of sort of 5-year money. But it's also volatile out there. It really, really depends. This is mixed signals, I think, at the moment, because we've got fairly negative inflation news, actually, and the risk of more inflation being driven by Trump tariffs, which, if we avoid them, fantastic, but other countries won't, and that will have an impact on us. But then at the same time, we've got weaker economic data than we've had for a little while, and the government's very focused on growth. And one of the triggers to stimulate growth is to reduce borrowing costs. So it's hard to see how all of that comes out in the wash. But the messaging from the Bank of England at the moment is cautious, and they are talking about more rate cuts, but they're talking about them being kind of slow and steady. What I expect is that at some point during the year, something will happen, and either growth or inflation will become more important than the other. And if inflation becomes more important, we'll see higher rates and less reductions. If growth becomes more important, we'll see more cuts and maybe more reductions in mortgage rates. But it's so hard to call what way it might go.
So I'm going to try and give a highlight of that in my own words. So what you're saying is you'd expect, all things remaining equal, that your mortgage rate, so your typical Shawbrook product at 6.5%, might drop by about 25 basis points by the end of the year. But the factors that are really going to impact it are, if inflation is more of a concern, then we might see that move up. But if growth is more of a concern, then we might see that come down. Is that fair enough?
I think that's how the market will move. Yeah, with cost of money and everything else. The other thing that impacts it that you don't know is obviously just competition. So every bank, every lender has got their own, running their own businesses. They've got their own commercial objectives, and it's a really competitive market out there. It feels like the lending market in general is very active at the minute. So It's not, sometimes rates won't, very nicely and cleanly follow the trends in the cost of funds, because you might do something because you want to drive more business or less business or whatever it might be within your own organization.
Because it certainly seems like there's lots of capital out there, and it's not like savings are completely drying up and people are not
No, not at all.
in the banks. So it's very different to something like 2008, where there was kind of a halt in all transactions. So there's money still needs to get out there because, like you say, these are businesses and they've got to make a margin. So if they're not getting money out the door, they've all got a cost of capital to keep to. So yeah, money's got to flow.
Yeah, I'd say it's almost the opposite of 2008. 2008, we had kind of a supply side problem with money. No one wanted to lend. Now we've got more of a demand side issue where there's less demand for borrowing than there has been historically. But that's where I think things are starting to change, though, and things are starting to turn. And um, we're seeing more purchase activity come through now, even for buy to let, but it's not in the buy to let mortgage stats, it's in the bridging stats, because the type of investor that's active is buying things where they can do a refurbishment and add some value, as opposed to buying something in great condition you can just stick a tenant in, because that's how they're making the economics work for their business. So um I think we sort of said it at the start of the conversation really well, but I think people are getting their heads around a new normal of higher interest rates and then adapting their strategies to succeed and make money in that environment.
That's such a fantastic comment, and it just goes to show that when people are looking at this data, it's looking at the context of it, because you often sort of hear these kind of stats spewed out, but with no context. But adding that context around, say, look, it's not in the buy to let data, it's actually in the bridging data, because the people that are still in the market cannot make a buy to let work with the frictional costs of stamp duty and all the other things around it. So they've got to add value somehow. And in order to do that, they're financing through bridging. So yeah, totally agree with that. And it makes absolute perfect sense. So yeah, really, really interesting, Dal, as always. Thank you so much for giving us your time today. Is there anything else you think our audience should be aware of in the markets?
Oh, that's a good question. And I think whenever you need a bridging loan, commercial mortgage, or a buy to let, just give us a call at Shawbrook. That's the main thing that your audience needs to remember.
There you go. Okay, brilliant. Thanks so much, Dal. Always a pleasure to speak to you, and hope we can do it again soon.
Thank you very much, Rod.